Okay, well, welcome to the Oregon Executive MBA Alumni Network and Duck Career Network. We're combining two categories here for tonight's event. Great ideas are cheap, what actually gets funded. I will let our host, Jason, introduce our guest, Josh Tanzer. And to our OEM alumni attendees, we're excited to have you here, connecting back, obviously virtually, as we'll do more and more of these hosted. This is the first of many, continuing our education, our professional development, social events throughout the year. Stay tuned for more that are coming, of course. Check those inboxes. Our goal, obviously, is to connect you together in two different cohorts or many cohorts and our alumni, and welcome some of those graduate students back, as well as we have some listening in that are active. So the Duck Career Network is a program of the UO Alumni Association and offers a range of career resources and programs. Some are virtual, some are in person. Again, stay tuned for more. And all of you at the alumni at high levels, please and welcome. With that, I'm going to turn it over to our host, Jason, who's going to jump right in. Please feel free to jump in the chat if you have a question that we can get to at the end of the event, sometime around 7:10, 7:15 for those questions that aren't answered through the discussion. So please post to the chat board. With that, Jason Loomis, a fellow graduate of the OEMBA program from a couple years ago, take us away.
A couple years, class of 25. That was decades ago. Thanks, Michael. Thanks for being very nice to that. Hey, thanks everybody for tuning in. We're really fortunate to have another amazing guest. This is the third one I've done of these. Another guest in the U of O Executive Alumni Series. His name is Josh Tanzer. I'm surprised he isn't in Davos right now with all the other finance geeks. I don't know what he's doing with us, but we're lucky we got him. Josh has spent about the last 30 years right in the middle of the tech investment world. He
Yeah,
had
don't,
senior
that's supposed
roles.
to be a secret, but yes,
Okay.
it's been that
A
long.
few years in the
Huge.
tech investment world at Credit Suisse, Lazard, Jeffries.
Right.
Over that time, he's raised over $6.5 billion in growth capital for got over about 100, right? 100 software and tech enabled companies.
Correct.
He's been involved with some early names. You probably don't recognize them. They're really small bit players, kind of like Oregon State. Really small bit players like Salesforce, Splunk, Vanage, a few other companies you just never heard of that he's been involved in. Outside of investing, Josh is a former Peace Corps volunteer who helped build one of the first microlending programs in Latin America, and he served as board chair of PS Hearts in Southern California. Today, what he's doing, he is the co-founder and managing partner of Principia Growth. It's a late-stage tech investment platform that works with family offices and individual investors. Josh, it is great to have you on.
Jason, great to be here. Thank you for the chance to talk about something I've been passionate about for obviously many years. And it's great to be here and be, an invited guest of the Duck Network.
How did you, something I didn't cover in your whole biography was kind of like your perspective. Like, how did you get into what you're doing? Like, what in your journey that I left out of your bio? How did you get to where you are?
Well, I'm not gonna. I will definitely give you the abridged version, but I forgot, Jason. My legal. We run a family office investment firm, but we do have lawyers, and they asked me to always to say a kind of a disclaimer before we get into any details. If I okay, can I do that?
Yes, the this is not investment advice disclaimer. I see it coming.
That's right. That's exactly what it is. So if you just bear with me. I read it from my phone here. The information provided during this podcast is for general informational and educational purposes only. It's not intended as a substitute for professional financial advice. Before making any financial decisions, you should consult with a qualified and licensed financial advisor to consider your specific circumstances, needs, and objectives. Good words to live by. Okay.
All right, everybody, take that to heart. A bunch of MBA grads on the line. I get the we all think we know it.
Yeah, yeah. Well,
Yep.
this is why we have a lawyer. It's all
So
good.
to a
Yeah.
little bit. Give me the we're in a very long elevator ride. How'd you get into what you're doing?
Yeah. No, when I came out of college, I went into the Peace Corps. I was actually a business volunteer, which I think they still have. And I wasn't more of an operating role of this micro lending business. And I quickly realized, I like building things. And so when I went back to the United States, I got into through some connections through my university, University of Denver, where I went to undergrad, got into Wall Street, and I was in M&A, mergers and acquisitions, and especially in M&A back then, in the 80s and early 90s, it was more about, hostile takeovers and busting up companies. And it really wasn't about building things. And I didn't find it very gratifying. And so I quickly pivoted my career, to be fair, after about 4 or 5 years quickly. So I got some good training and then went into what was the growth, what's now termed kind of growth equity business, which is raising capital for, startups that are later stage, have product market fit, have revenue, but need to pour some fuel on the fire. And I loved it. I found my passion. I was, as you could imagine, maybe 7 or 8 years out of college. So it wasn't like overnight. And then from that, I just knew I was at home. I liked working with entrepreneurs, and I like building companies. Remember, I'm not from an operating point of view, but making sure they get capital to be able to grow. And really, that's what I was doing in the Peace Corps. A little bit of a side. Micro lending is all about not so much creating profits for the bank that's lending the money. It was a not-for-profit bank. It was really about creating jobs in lesser developed areas in the country that I was living in, the Dominican Republic. And we would make very small loans for working capital, and then the entrepreneur would grow their business and employ more people, and we would track that. So I want to be clear: they had to pay back the loan and pay our interest, but we were really tracking the growth of employees. And so that, I don't know, that just stuck with me as a good thing.
So you were more interested in the impact that your work had with that organization on.
Yeah,
that's fantastic.
I mean, this was not for profit bank, but I want to be clear: we charged interest, and people had to pay their interest. And if they didn't pay back the loan, they weren't going to get more money, obviously. So anyways, I took that concept of growing businesses, and when I was doing M&A with Bear Stearns. It was one of the big investment banking firms. Got a lot of great training, met great people. I just didn't love the job itself. And so then got recruited away to do this kind of growth equity financings. And I was arranging the financings and helping companies find that capital. Back then, I mean, there was like 30 firms that would do non-control investing. And I don't know if I'm exaggerating when I say 30, but I literally don't think there were 50. And today, there are thousands. So I kind of grew up in the industry and watched it grow.
Gotcha. So, when you made the shift, sorry, I can't get this picture out of my head. Which one of the sharks in Shark Tank are you most like? That's what pops in my head when you tell me like I'm an investor and I looking at companies that are growth that are looking for more investment.
Off the top of my head, I'm gonna maybe oh my God, who the Canadian guy, not Mark Cuban, but the other gentleman. I can't remember his name.
Oh, that got like a little, not much hair.
No, he's got a lot of gray hair.
O'Leary, not O'Leary.
No, not O'Leary. The guy with
Herkovich.
Yes,
am I saying this? Robert Herkovich.
Yes,
yeah,
Robert. Yeah. Probably most like him. But I want to be clear. The reason why I hesitate is the other thing I really gravitated towards was businesses to use technology and to have businesses become more efficient. And so I've really never been on the consumer side. And if you know, Shark Tank is really all B2C.
Yeah.
And so it's not exactly in my purview. It's tangential, and I certainly have other opinions about Shark Tank I can share with. But I do think Roger, he would be the one closest to how I think about deals.
Gotcha. Well, what kind of companies does Principia Growth typically invest in? What are the verticals that you're in?
Yeah.
And why? Sorry.
Why? Right. Well, yeah. Why you want to stay in your swim lanes? I actually, for life, you want to keep expanding your swim lanes, become versatile, but you don't want to get out over your skis too much, mixing metaphors here, and get into sectors that you really don't know much about. For example, biotech or med tech, and B2C is not an area that I've spent a lot of my career in. Business consumer businesses. So when we started Principia, I was with a couple other partners. We all came out of the B2B world. And so you want to invest in things and then why I like that is just kind of what I was saying is that it's fun to help companies grow and help other companies become more efficient at what they're executing on. And really, all of our companies we invest in basically do that. We call it now future of work, whether it's at the chip level, getting semiconductors that are more productive, less power, more throughput, to software where it's becoming more automated, and then obviously robotics, where it's becoming a lot more efficient to run a factory or a warehouse. These are things I've always, going back to really when I was a kid, I was more interested in than kind of selling, things to consumers. I never had that bug or that that interest as much. When I started out a long time ago, asking my father. I remember, why I was collecting baseball cards when you're a kid, and I'm not even sure they still have those. And they cost a quarter, and I was like, well, why do they cost a quarter? And then my father, who was a trained accountant, would explain to me how a company would come up with their cost of goods sold, and they need a profit margin
How old were you when you were having these conversations?
in the 9 to 10 range.
Wow. Okay. He's handling cogs at 9 to 10. I didn't handle that till college, but that's great.
Yeah, so that's by the time I got into college and had
An early start.
accounting classes, I was like, yeah, I know this. But it's helped having a dad who's in accounting and who he himself enjoyed accounting. So anyway, that gives you a little bit of insight into how my brain was thinking back then.
What are some of the characteristics that make a company a good fit or a bad fit for you to invest in? What are some of the things that you look for?
Yeah, well, it's a little bit of a long list, but there are probably approximately 10 things that we look for. But a couple of key ones are, sustainable, attractive growth and at scale. So, companies that are, a couple million in revenue, sure, they can grow 100% from 2 to 4 million, or even 4 to 8. And I don't want to dismiss that. Anybody that grows a company from 4 to 8 million is doing great. So I want to be clear. And there's nothing to be ashamed, or it's super impressive to be able to do that. But from at our level, we're basically like institutional capital. We need companies that can really scale. So we're looking at companies that start up around about 20 million of revenue to 40 is kind of in our sweet spot. And then we want them to grow approximately 50 to 100% from there. And that's much harder at that scale. And then we got to be able to see that they, even after that growth spurt of a year or two, we'll want them to grow, 30% plus, because that's where the value for an equity investor. And I should step back. So we're growth equity investors. We're not on the fixed income. We're not on the debt side. And we're doing private, illiquid investments. And so those investments need a premium return because since there's no liquidity in that security, you as an investor deserve a premium over what you can get in the public market. So you got to start with that concept. And so to get there, you need companies that are going to be growing pretty in a pretty strong manner. Otherwise, you're just not going to get the returns that you need. So you need sustainable long-term growth first. And then second, I would say we look at the management team. And it's something, Jason, that I sometimes, as you said, I've been doing this for a few years, decades. And sometimes you go through stages where you kind of forget how important management is. And then maybe you invest in something, you go, oh, that's why management's so important. So when you see these CEOs of these multi-billion-dollar companies, those people are talented. Anybody can put on the hoodie and look like a tech exec. But the people that really run multi-hundred million, let alone multi-billion-dollar revenue businesses, that takes talent. It's managerial talent, it's product talent, and it's vision. We like to say seeing around the next corner. Because in tech, and I'm sorry, we're really focused only in the tech sector. And I'll explain different subsectors within tech that we focus in, but just not consumer and not med tech, things like that. Is it's hyper competitive. So if you don't keep innovating, you'll be eaten. And so we look for sustainable growth. We look for companies that we think can maintain that, and then we look at the CEO And usually the number two person we look for is that CRO, Chief Revenue Officer, VP Sales. They hold different titles. It can even be different than that too. Sometimes COO. But generally, the person who's going to help drive that growth.
That's
And
interesting. I actually would have expected you to say CTO there as a second because it's a tech company, but no, your sales and growth
yeah,
is
we
interesting.
by the way, everything I say tonight is our opinion and our lens. There,
You could read that disclaimer again if you'd like.
yeah. Well, that was more of a just there's different ways to
Yeah.
do things on the planet Earth, and this is how we do it. I'll say it that way. And it's not, to be fair, it's
Yeah.
been successful, but that's not to say other ways aren't successful. So no, you're right, Jason. I do think there are probably some other growth investors even that would place more emphasis on the CTO than we do. We kind of I just kind of gave away the story there. As a growth investor, remember, we're not venture. I think people understand this. Venture is early stage. That there could be some customers. There's usually not customers, and so it's all about the product, and it's all about the CEO and his or her vision, and perhaps the CTO too. But at our level, we need that CRO who's going to take us from 30, 40 million of revenue up to 200 plus. And is that person in the seat now that can do that? By the way, I want to be clear, just because that person isn't in the seat, maybe that's not the right person. If there's enough other, good things around the company, we still might want to invest. But we put a lot of emphasis on who the CRO is.
So, there's a lot of, I think it's known in the MBA programs too, about how much venture capitals also help guide the startups and help them make those connections, get the right people in those right roles. At the growth stage, is that a factor at all? Or are you kind of just hands off? Okay, here's my money, go do your magic. How much hands on do you get involved?
So yeah, that's a great question. By the way, I should step back. First of all, there's no bad question. I always say if you don't know the answer, every question is a good question. So let's start with that. But yeah, we do get involved. We try and be helpful to our portfolio companies. Not all growth, I would say most growth investors do not. But we set up Principia. So I've been doing this for a while, and I saw that a lot of the growth investors really are hands off, and they really can't help their portfolio companies. So when we set up Principia about 7 years ago, we started with my co-founders, former CEO of Salesforce and CFO of Zendesk. We recruited a deep advisory board, as you know, Jason, of people in the sector, in different sectors within tech that can be helpful to our portfolio companies after we invest. So we get involved with everything from IPO readiness, which is a preparatory process that takes about a year for a company to go public on the financial side. And we have some experts in that area. We get involved with go-to-market strategies, what's called GTM. We have a couple very experienced people on our advisory board that can help CEOs with the GTM, with developing a sales organization, best practices around sales. And then even AI tools now. We have someone who is an AI savant, if you will, from Palantir, who is a senior data scientist there. And he can help our portfolio companies think through different tools or different methodologies or different workflows around AI. So our bench, we call it a deep bench, Jason, are available, every day to our portfolio companies. We don't push them. We don't push our bench onto our portfolio companies, but we answer the phone when they call.
Gotcha. Thanks.
We actually do a lot of enterprise customer introductions too, because myself and my partners have been around for a while, so we know a lot of CEOs or senior level people, C-level people at Fortune 500 companies, and so we can help open doors. And the difference between, so we're not there, but we're not a venture capitalist. We're not going to be in there every day talking with the CEO and CTO and wondering if the product should have this feature versus that feature. That's the purview of the VC earlier stage investors, and so our involvement is at a higher level. And let me say it this way: if we have to be involved helping the company determine some of the product features, we've screwed up. It's not really a late stage deal.
And I'm sure this goes without saying, but I want to ask just to get the confirmation. So at the VC stage, early stage, I'm assuming it's much higher risk, but much greater reward. Like you'll get a lot more out of it, but you also have a higher risk. How does that how does that taper off at your stage? Like, is it 10x, 20x,
Yeah,
100x? Like,
yeah.
what's the payoff and risk difference
Well,
between at
well,
the VC stage?
well, the good news is there's no cap. We do look for asymmetrical returns, and what I mean by that is we invest in preferred stock, which some people may not be familiar with that, but that's the it's equity security, but what it sounds like it's at a preferred layer, so it sits on top of the common, and if the company is sold or liquidated at a price below our valuation that we came in at, we recoup all of our capital back. So, which it's to someone maybe not in the business, that may sound great, and it isn't bad. It's definitely good, but we're trying to get a return. So, getting our money back without a return really wasn't the objective of the exercise. So, I want to be clear, it is good, and that's why we only invest in preferred. We don't invest in common stock. So we start with that, and then we try and 2 to 4x our capital. And I say our capital because it's our investors, but it's also actually we put our money into our deals as well. And we try and do that in kind of 1 to 3 years, so pretty quickly. Venture capital, I think the paradigm right now for VC is, every VC deal, everybody wants to 10x their money, which is great. But you got to look at a couple things, kind of not the dirty little secret, but some secrets about venture capital that, again, aren't intuitive, aren't obvious if you're not in the business, is that 10x is now over 10 plus years. Very few early stage deals get exited less than 10 years. So you can start doing IRR calculations on what
Yeah,
that's
of what that
like.
10x isn't starting to show very as a good payoff.
And then here's the more secretive thing about venture capital. Why certainly I was never that attracted to it, even as taking my own capital and putting it in there, is the VCs get diluted quite a bit over time as the company continues to grow and take in more capital. There's a lot of dilution that goes on. And what the large VCs have done to counter that is they've raised large funds so that they can invest their pro rata rights into each round and maintain their ownership. But if you don't do that, if you don't have the purse or the pocketbook to do that, you're what looks like if you invested 100 million valuation and a company gets exited at a billion, but there's been 5 rounds in between, that is not going to be a 10x. That it still may be a 3 or 4x, but you're going to get substantially diluted over time. And so the combination of the long term to exit on a venture capital deal and the amount of dilution that you suffer by additional capital rounds, it's a challenging business model. I will say the top groups that do it very well, and there's a top 20 or 30 firms that figure out how to do that and have big funds so that they can maintain their pro rata. But there's approximately 5,000 VC firms. They're not all getting 10x's, and I think everyone knows this intuitively. The 10x is on every deal is supposed to get a 10x, but the experience level is about 1 or 2 of those companies creates the 10x. The other 7 or 8 go to either nothing or near nothing.
Yeah.
And our business model is the inverse of that. So 4 out of 5 of our deals get our 2 to 4x, and we always have a deal over the course of a 5-year period that doesn't work out, and we'll take either a partial loss or just get our money back, something like that.
Yeah. Okay. Talking about that, about you talk about sustained growth, and what you look for. What differentiates a company that looks good on paper? And have you had this experience where, wow, the numbers look great, they've got the sustained growth, but you're like, hell no, I'm not backing them. What are some of the things that came out of that? Or maybe like, what's a quiet red flag for companies that nobody
That's
talks
good.
about
By the
publicly?
way, you see people on resumes, right? I'm sure, Jason, you've seen people with resumes.
People look good on paper. Yeah. Well, I've seen like I in my finance class, oh, this company looks great, and you start digging in. So I'm just curious what you guys, if they show you the numbers, everything that adds up in the spreadsheet, what are some things that you go,
Yeah,
no, we're not going there?
yeah, there's all there. It's a lifetime of learning. that's the other way you can do this for decades. But first of all, you have to have a love of learning. I think if you're a venture capitalist or if you're growth equity, and probably almost any type of investor, because you're constantly learning about new businesses, about different business models, different sectors. And we're doing defense tech right now. We're doing semiconductors. We're doing some space. We haven't pulled the trigger on a space tech deal yet, but we've spent a lot of time with different space tech companies. 10 years ago, I would have said, no, we don't do those deals. So you have to constantly learn. And when you learn about different red flags. The reason why I'm bringing that up now, there's different red flags in different deals. But we try and get under the hood and figure out if companies can grow a lot, but if there's not, it gets back to a little bit of my accounting background. We met a company 2025 had great growth, call it 100% at scale. Some interesting high quality CEO and CRO. But when you got into the details, it appeared that their financial controls, there were none. And so we weren't sure that those numbers were real. There was no CFO, and that's okay. You can have a strong VP of finance. There was no audit. Well, that's okay. You can have reviewed numbers, or if there's a strong CFO. It turns out we think that the numbers, we think they're just kind of made. We think they were directionally what the CEO wanted, but we're not sure that they were real. So there you have to some nuanced thinking. And by the way, they went out and raised a bunch of money, and we'll see what happens.
That's the years of experience it gives you, just to you could, by intuition, you're like, something's not right in those numbers.
Yeah, you start to, it's a puzzle. The best way I could say about it, and we just, as Jason, we just closed on a couple of investments, and the puzzle just came together, and it was, strong numbers, strong moat, and we can talk about that in a minute, what a moat is, a defensible market. CEO who either has experience, been a CEO before, or is running the company at profitability, at EBITDA positive. So you're like, even if the CEO has no experience as a CEO, but he or she is creating a profitable business, growing nicely, like that, again, that's talent. So a deal comes together. It really does. The way we see it, it's like we put these pieces together as a puzzle. And then it's most of the time the puzzles, you're missing pieces.
Yeah.
And then you have to, so even sometimes you get 9 of those pieces in, and it's frustrating because, to do a puzzle takes time and effort. And it's also, you want to get to the finish line. You have you break up every day wanting to get to the finish line on an investment. But when you can't find the final piece, you got to have the discipline. And this is myself, but and the people you surround yourself with, to walk away.
Yeah.
And that's probably the hardest thing, is coming together, putting a puzzle together with 4 or 5, 6 of the pieces, including maybe 7 or 8, and really liking the people you're working with, that you're going to potentially back. And then you just sit there and say, well,
we gotta break up. This ain't working out.
Yeah, it isn't working out, and life's too short. And remember, we're investing in private securities, so it's going to be a multi-year relationship. Right. So you do think about it as it's this person you want to, be with for the next 3, 4, possibly 5 years.
Yeah. Can you go back to the moat thing? Really caught my interest. Can you explain the moat?
Yeah, that's an important one. So along with the CEO being very important, and CRO is our lens, that's what we think is very important. The moat, and most investors would agree with this, if not all. A defensible moat around the business. So the business is growing. It's 20, it's 40, it's 50, 60 million revenue. But what I said earlier, tech is very competitive. Especially in software. And Jason, this. There's software. There's almost nothing you can. I think get some IP, get some patents, but nobody's going to litigate that. Assume whatever you're doing that's successful, people will replicate it. Remember, copying is the sincerest form of flattery. So So Salesforce was a good example. So when we invested in Salesforce, um, Mark was way ahead of the market, Mark, the CEO, and he he had created a moat not from IP, but really from having been a first mover, and having hundreds. I don't remember if there was 1,000, but it was hundreds of small businesses were using Salesforce. No large. I think there might have been one enterprise customer. I think it was General Motors actually, and I think it was because we saw that he was out there in front, even though software is replicable, people can imitate it. We thought he was going to win because he had that moat of being the first to market and hundreds of customers with very little churn. And we look at churn, and that's how the dogs are eating the dog food, pardon that expression. But people like this, they just didn't get sold something that they bought once and churned. They they got sold something, they bought it, and then they bought it again. And that's a real good signal to see. And then because he had one customer that was enterprise, our feeling was, remember, there's billion. I always like to say we're not as unique as our parents said we were. There's when I was born, there was like 4 billion people on the planet. There's 8.2 billion now.
Yeah.
So anyway, my point is, if we saw one enterprise customer that was using the product and hadn't churned, we're like, oh, we can extrapolate that more enterprises will. So even though it was an SMB product when it first got started, we could see it was going to get to enterprise, and so we were able to put together the puzzle. Great CEO, moat, good growth. The only thing, yeah, it was a big valuation at the time, but we got over that, and thank goodness we did.
Right. We got a few minutes left before we start. I want to head off to some questions that have been submitted by some of the cohorts and some of the attendees here. But there's one topic that's the elephant in the room these days.
Uh-oh.
It's a term that's taken this country by storm.
Uh-oh.
Everyone's tired of hearing it, but I just have to ask about it. Let's talk about 6-7. My 2-year-old is doing 6-7, 6-7, 6-7. It's crazy. Yeah, but actually, that's the wrong script. But AI,
it
right?
can't be. That's not me. That's not me.
Okay, not you. The different generations, about 5 generations below. AI, man, right? Like artificial intelligence. So
Yeah.
where I'll start off my first question around AI because I'm sure it's in your consideration for everything you're investing in.
Yes.
Where are you seeing AI create real competitive advantage versus feature level noise?
Yeah. Well, look, let me step back. AI is definitely here. It's a sea change. It will become as big as what the internet became. And if you recall, going back a few years, the internet didn't overnight change. It was really once everyone got broadband in the early aughts that it really blew up. In the late 90s, the internet was certainly there, but it wasn't what it became. And so, and by the way, I say this about all new technology, it improves, whatever the first iterations are always kind of, okay, that's interesting, but, is it really game changing? So first time I had I like to talk about this. I did a VoIP call, voice over internet protocol, and which is, what we're doing right now, by the way. The first time I did a VoIP call was '03, and it was terrible. and the CEO was so proud that he was able to create this new technology. I really didn't invent it, but was able to deliver this new technology on a phone. And I agreed that it was incredible. The phone quality sucked. You could barely hear the other person.
Yeah.
But I said, let's invest in this company because what Rev 1.0 of any tech is going to be light change difference from what it's going to be at Rev 5.0. And that company was Vonage and ended up being a good investment, became a public company. And so when we talk about AI, and I also want to talk about humanoid robotics, I think today it still is very good. And I know I'm a big user and we've been using it for a few years, and it's only going to get better.
But what have you seen any specific verticals in your experience so I'm going a little anecdotal from my experiences that AI is slapped on every company. Every company you go to the website, we're in AI, especially in software. Are there verticals in software, certain subs of software where you're seeing AI create real competitive advantage? Or
I think the one area I would say we've seen is customer service software.
Okay.
where the AI agents are taking over. And we kind of saw it in a portfolio company of ours that it does HR recruiting software, where the AI also is taking over. So yeah, it's penetrating into different sectors or subsectors, let's call them, and it's just a matter of time for it to permeate more into many different areas. I'm a big believer, So and let me just for the everybody to understand, there's AI native companies, the frontier models, the LLMs, and then the data center companies. That's AI native, and then there's everybody else that's using AI, and so we I want to be clear, we'd be very interested in AI native companies to invest in, but the valuations got very frothy very quickly ahead of their core business, revenue, profitability, things like that. They're now catching up, and I've had to hope, I guess, we're going to be investing in an AI native company this year that'll be more in line with our lens of how we view risk reward. Um, yeah, and then quickly on robotics, because I know robotics is getting a little bit, depends on maybe who you talk to, a little bit of a bum rap. I mean, again, Rev point 1.0 of these humanoid robotics, yeah, I mean they look funny, they move around a little bit janky, and they can
Well, it's like your
barely.
VoIP story. It's like 1.0 the VoIP, right? Yeah.
That's my point. Boy, I met Neo, which if you Google or see watch a video of it, and you kind of go, okay, that's nothing great. I'm like, no, it is great. It's not great today,
Right.
but where they're going with this, and I just mentioned there's a handful of humanoid robotic companies out there. There and if we had an investment, I would obviously share that with everybody. We don't have an investment, so I can promote it. And yeah, I just think those technologies are going to happen. We have invested in other robotic companies, by the way, that have done well. They're not humanoid robotics, so they're more traditional industrial robotics.
Gotcha. This would be a good time to segue over to some of the questions that came in from the audience. One question came in. I actually want to go back to how you talked about how much it's your intuition and the experience that you have when you're looking for things not to invest in a company or the things that seem fishy. This person was asking any suggestions for how to get that experience. They're asking like any suggestions of how to
Oh,
position oneself for a career in VC or PE. Like how do they go about it?
yeah, well, you start off being curious. If you don't have a curious mind, that's if and you know if you're a curious person wanting to know how stuff works. If you don't have that, VC and even what I do, growth equity isn't probably the right career path. But to get started, it's always challenging. Look, there's a lot of it's competitive. I mean, every field's competitive. But I would look at internship. I would certainly use your alumni network. I think that's very important. I got into this industry kind of in essence through a professor I had who I just shared with my professors what I wanted to do. And one of them had a contact in New York City. I'm sorry, I went to school in Colorado, in New York City. And I got in my first job on Wall Street was actually with Chemical Bank, which ended up becoming part of JP Morgan. Um, and so I would use your network, use your family network, use your um, university alumni network, use your professor networks. Hopefully, you got good grades and your professors like you. Um, I think that definitely helped me. And then internships. If somebody's not, I, I don't care if you're paid or not. I mean, I know students have no money, so being paid is better than not. I got that. But if you can get a decent internship and it's not paid, to be able to throw that on your resume that you spent 3 months or 4 months helping out some VC firm or some startup, you should absolutely do that. And I want to point out here because it has come up, and it's over years. You can imagine how many younger people I've helped. By the way, they help themselves. I can facilitate some things. By the way, and that's the other thing. But don't expect anybody to get you a job in this industry. You need to get it yourself
Great
by being
advice.
prepared and hustling and working hard. And I want to emphasize that being prepared. Sometimes younger people come to me and want me to connect them with so and so or something, and they're like not they're not prepared. they, come in professional, come in. And another thing is come in with a specific ask. The last thing somebody, at least in my opinion, that I want to hear is, I'm not really sure what I want to do. What should I do? Like, you should go back and figure it out. Let me get to my day job. And then once you figure it out, maybe I can help you. So whenever you go for help or assistance, I don't want to call it help, but if you remember the person who's helping you, even if they're your mom's, college classmate or your dad's, professional friend, they're taking time away from
Yeah,
what they need to be doing. They're taking time away from their family to talk to you. So you should come buttoned down and super prepared. And
that's
and if
great.
you don't, I guarantee you, they'll notice it.
Yeah, that's great advice. Um, Move on to my next question. This is a good one. Came in from email from someone before. How do investors prefer to be approached, and what type of materials are most helpful during an initial conversation?
Yeah, okay. Investor, I assume for a deal to invest in a company, it sounds like.
Yeah, yeah.
Yeah, yeah. Well, perfect time to ask that. So don't come saying I got a great idea. Yeah,
What was the title of this? Great ideas are cheap.
yes, right. And now I can use my Churchill quote. So, which I have a few. So Winston Churchill, one of my favorite statesmen, said when the Americans had not yet joined the war referring to World War II, he said, "Thought without execution is mere idleness."
Mm,
And so when you approach somebody for an investment, come with a deck, a few pages, um, send it in advance. Uh, Remind the person when you get on the Zoom or the call with him or her that who you are and why you're talking to him or her. Remember, that person has a day job. That person has a family. You might be one of several people that are
yeah, that's
approaching
great
him or
advice.
her. So identify yourself, identify why you're talking to me, so that okay, we level set everything, and then come with some kind of prep materials that they can review. And obviously in today's, there's no excuse to not have that prepared material with Gemini and ChatGPT. This is
Cheat. That's not cheating. Use AI to get
Oh
you
my
to
God.
get you
Yeah, just
ready.
use it.
Yeah.
I don't care. I don't care. You'll see that I'm pretty sure, I know this is always just my opinion, but I'm pretty sure I speak for my industry. Nobody will care that it's created by
Yeah.
ChatGPT or
A
Gemini.
business plan is a business plan.
That's right. Yeah. So that the biggest mistake I see from some people is they come in just, I got this great idea, and they just start talking. And I'm like, well, I don't even know you. It's just
Show
like,
me the execution.
yeah, yeah.
Great. That actually good segue about execution. So I have a from Lindsay Herzog. She submitted this question in our Q&A in the Zoom chat, and looks like she's at the execution stage. She says her question is, I'm a startup biotech company.
Oh my
Some
God.
investors view us as having blown our cap table. Are there certain investors that are still options for us? We are pre-seed, delivering product to our first customer next month.
That's a very specific question. So, it's a biotech.
It says biotech company here. Yes.
Yeah, yeah. So that's not an area that we spend any time in. Again, what I said earlier about staying in our swim lanes. But conceptually, and she said she blew through the cap
It
table.
says that the investors view us as having, quote, blown up our cap table. Do you know what
Yeah,
that means? I don't know what that means. Do you
and
know
I,
what
I
that
think
means?
it kind of means they raised too much money, and
Ah, okay.
they need more capital.
Ah,
So
so
it's
daddy's wallet's empty.
Yeah, something
Okay.
like that.
Okay.
By the way, it's a very specific question, just specific
Yeah.
circumstances, and in a
Sure.
sector that I'm not that familiar with. But there, just anecdotally, there's always the pivot. You're doing something that may not be uh, getting traction, and by the way, this does give it another lesson. And if it's not getting traction, you may want to pivot to some other product. Obviously, the best well-known pivot was Twitter, which had a totally different business, and then it wasn't working. They were not getting traction, and they blew up their cap table. And on the next financing, they said, "Hey, we'll try this," and it's what became Twitter. So if you're at that stage, I would say at least some kind of pivot is called for.
Gotcha. Great. Thank you. Another question that was emailed in: what mechanisms are placed to ensure that a funded company performs to their business goals and their progress is measured? Yeah. So how do you invest in the company? What mechanisms are there to make sure that you can go check in on them and,
Yeah,
hey,
great question. Again, no, there are no bad questions because if you don't know the answer, that means it's a good question. But this is a nuanced, interesting question, and there's some history to this. So first of all, we try to only invest in people that have consistently hit their forecast. So remember, we're coming in the company, they're 3, 4, 5, 6, 7 years old. So we can see the history of how they've performed. And again, from the gray hair now, what the thing I've really noticed is people that have succeeded tend in the past tend to succeed in the future. So if you see a company that's been hitting their forecast, and when I say hitting, it doesn't have to be exactly, but in the ballpark, 10%, 5%, 12% of their forecast, you can kind of bet that they're going to continue to do that. And so there's no substitute for that, number one. Having said that, we're coming in as a preferred stock investor, so we're going to have some downside protection there. We're not coming in as common. And in terms of how well the company performs, historically, we used to have things called reset provision, where if the company didn't hit its forecast or approximately its forecast, whether it be the revenue or the EBITDA number, you would reset your valuation to a lower price. That in the industry got, kind of lost as more investors came in. First it was the hedge fund investors, then it was actually VC investors now raise growth funds. They come into our market, and then sovereign wealth funds have come into our market. And I've talked to them about having reset provisions. A lot of these people don't even know, never even heard of this. So this is the industry really used to always kind of rely on it. If you're doing a stretch valuation on a deal, you can have a reset if they don't hit that forecast. But these days that's kind of not, it's not de rigueur. It's not what's accepted, in part because it does set you up to be a little bit against your management team. So your management team is going to want to hit that number, and some people on the board, the VCs, think, well, you don't want her to hit that number because then you're going to get a lower price. So I understand that logic. I mean, I would never think that way. I would always want them to hit their number because it's good for them, good for us. But right now, we really rely on looking at the history of the company and then coming in at a price that we still can get our 2 to 4x ultimately. So we absolutely model the company out into a forecast that we think is going to happen. It's always substantially lower than what management thinks. And then we pencil out. Yeah. And then we pencil
that
out
sounds right.
our 3 to 4x. And this is why we walk away from 99% of the deals we look at, because we can't pencil it out. And so if we can, this goes back to the puzzle, getting all the pieces. One of the big pieces of the puzzle is, can we get a good return?
Can you share that again? I think that was an important statistic, and you were not exaggerating with that. You would walk away from 99% of the deals that come up from your way. Wow.
I probably won't go to, yes, but yeah, we see hundreds of deals a year and we do only a few. And it works out to approximately 99% of deals we pass on. So we invest in 1% of the opportunities we review.
Is that standard with other growth investment firms? Are they doing that same percentage? No.
No, no. I think most anecdotally, and it's funny. This came up I was at a conference last week, and at the conference you see your other growth investors, and we always get together and at the lunch table start talking about things. And most people invest in around 4 to 5% of the deals. So let me be clear, a clear minority. Nobody's investing in 25% of the deals they see.
But still, it's 4 or 5 times the amount that you're investing.
That's right. That's what it says. It really some heads.
So you're saying there's a chance.
That's right. Right. There is a chance. We will invest. That's why as you know, Jason, we just did 2 deals. It's a big deal. And it goes back to approximately 10 pieces of the puzzle. And if any one's missing, unfortunately, we have the discipline, because we're also a little bit in the wealth preservation business as well. We do want to make money, but we don't want to lose money. And obviously stuff can happen. We can have deals not work out, but we want to have those 10 pieces of the puzzles in place to give us the best chance at making the return we think we'd make.
Right. Great. So we've got time for two last questions. We're going to take one question from the audience and then one last question, sort of a closing question for you, Josh. This question comes in from Amber Yang, and this ties back to you said the two things: you look for sustained growth, and then you look for at the management team.
Yeah.
So her question is, how do you identify or differentiate good management from bad management?
Again, very great question, nuanced answer. You look at track record. So what have they? Again, we're not coming in as a venture when there may be no track record. Although a lot of times they're repeat CEOs, repeat entrepreneurs. So their last company. So we'll look at the last company or companies that they ran, or that if they were a CRO or a CTO of that company, how they perform, and then we'll look at the current results and see, how have they hit their numbers? Have they hit their forecast? Are they prudent with capital? And then, when years of experience, this is where experience counts, sitting in front of CEOs, hearing them talk about their business. What's the product roadmaps? Very important. Is it just are they just reactive to what their competitors are doing? Or are they really seeing around the corner and gonna actually gather more market share, more share of wallet of their customers by that vision that they have? So we use the word vision. Part of the puzzle is, does the CEO, do we think the CEO has good vision about where the sector is going? But we look at their track record as they ran this business, we look at their vision, and we look at their past experiences before this company. Now that's the best you can do. And then we do reference, we do, ungiven reference checks. So, because myself and my network, we've been in the business a long time, we'll know people that know the CEO. And so the couple deals we just did, the background checks we did on the CEOs were, top shelf, just not just as key as people. So that is important, but also as operators. And we're looking for that great operator, top shelf operator, that you can put your capital in there and sleep well at night.
Gotcha. Thank you for that. Okay, last question. This will be a closing question for you. What's a lesson that all your years and decades long experience investing, is there a lesson investing that you found surprisingly useful outside of work? Something that you learned in the investment and work world that this is actually fits outside of work?
Yeah, there's several, probably.
Give me your top two.
Well, mistakes. So, yeah, I mean, so when all investors make mistakes. So, we don't like talking about them, but we do. And when you make a mistake, you need to A, shout it, let people know you made a mistake, and B, look at it hard and figure out where you went wrong and what you can do going forward to adjust that blind spot. And you can do that, and you can take that into life, specifically around relationships. If you lost a friend, or your relationship with a friend isn't going well, use that methodology. Well, why is that? Ask yourself, Josh, what'd you do wrong? Obviously, it could be a more significant relationship, significant other. Obviously, it could be even a spouse. And I'm happily married, by the way. First wife, hopefully only wife. So anyway, so I think, really diving deep and thinking about and acknowledging your mistakes, you can bring outside to your interactions with other people, your children, whatever it is. So I think I thought that was a good one, by the way, because that's helpful really outside of work. And then two, going back a little bit to the previous question about, when you invest, you really are trusting people with that capital. And so you become a little bit sharper in who you end up becoming friends with and bringing into your life, applying similar discipline. I'll put it that way. And so I think that I've used as well. But and then by the way, on the more obvious one, I forgot is the big obvious one is what I've learned investing in growth equity, I apply to the public stock market too. And so that was the low hanging fruit. But yeah, no, it's investing is living, and the more experienced and the more analytical and thoughtful you are about what goes well and what doesn't go well, you can then take that and apply that in your life as well. Does that make is that helpful?
Does it? Yeah, yeah, absolutely. Yeah. I can't write it down because it'd be rude for me to be writing down while you're talking, but I'll go back and watch this again and write that down.
Yeah,
That's great advice. Yeah. Thanks for that.
it's
Hey,
something.
this has been awesome, man.
Oh,
Thank you so
let,
much. Yeah. Oh,
let
you
me
got
give
another one.
what?
Go.
No, no. I want to give my one complaint about Shark.
Yeah.
We mentioned Shark Tank earlier. I wanted to say something. And I got to tell you what Principia means, by the way. But on
Oh,
Shark Tank, one of my biggest, I'm always upset. They don't show they don't show the failures. I'm sorry, this is what made me think about it. So they show all these great stories about companies that got capital from a shark, and then they go on to create 10, 20 million in revenue, and that is great, and you should see that. But the converse is true too. The ones that don't work out, I mean, they're sitting on a gold mine of data of the companies that haven't worked out.
there's a lot to learn from that.
And there's so much to
Yeah.
learn from that. And I'm frustrated. You know, I think, let me be clear, I would learn from it, let alone, so
Yeah.
I think millions of people would benefit if they would have just a show, maybe once a year, I don't know, twice a year, take five, and it can be done with compassion. It doesn't have to be mean spirited on things that didn't work out. And so I'd like to see that. That I
Okay.
wouldn't.
Real quick, we do got to wrap up. What the name? How'd you get the name?
Oh, yeah, because people we get this a lot. So Principia is actually from the Latin word principle, and it was from Newton's Principia, the laws of motion,
Oh,
and it's from the
okay.
meaning of the laws of motion, and it's the principle. And we're a principal investor, which means we take equity stakes, and we like to think we treat people in a principled manner, and so it's a double entendre.
Double entendres are great.
Yeah.
Josh, thank you so much for joining us today. This was incredibly valuable for MBA community, and really appreciate you sharing your experience with us.
It's been a
Thank you.
pleasure, Jason. Thank you to you and the team, and glad we could do this.
And thanks to everyone who joined live, who's on now. Thank you so much. And to those who will tune in later on, I don't know if it's on Betamax, VHS, TiVo, Internet Archive, however it's going to be shown. I hope this gives you a sharper lens on how investors think in today's markets. Thanks, everybody.
Thanks, Jason.